Hello, this is Chuck Carnevale, co-founder of FastGraphs. With this video, we're going to look at how FastGraphs, the Fundamentals Analyzer software tool, helps the subscriber learn how to make this proper buy, sell, and hold decisions on very fast-growing companies with earnings growth that exceeds 15% per annum. My first high-growth example is LKQ Corp, a maker of recycled auto replacement parts. And since this company went public in October of 2003, you can see that earnings growth, as connotated by the orange line here, has exceeded 27% a year. The green box shows that earnings growth for this company since it went public has been 27.3% a year. With fast-growing companies like this, FastGraphs will automatically utilize our second formula for valuing a business, which is the PE equals growth rate, and we connotate that with the letters PEG for PEG. As you can see, stock price tracks earnings very closely in this company, and the orange line represents 27.3 times earnings. You can also see there's no dividends here, so 100% of the return from this company is coming from the growth rate of the earnings and how the stock price correlates and tracks with that. You can see periods where it's overvalued and periods where it's undervalued. The normal PE ratio of 22.1, the blue line on the graph, shows clearly that since the Great Recession of 2008, the market has applied a discount to its growth rate. So perhaps when looking at this stock, it makes more sense to focus on the blue line. Regardless, you can clearly see that you have a very clear picture here of the company's fair value based on the company's earnings growth rate. With our second example of fast growth, we're going to look at MasterCard. And once again, you see that earnings per share since MasterCard went public in May of 2006 has been very, very fast. Earnings have averaged over 30% growth. And in the beginning, the market was pricing the stock right in line with its earnings growth, or the orange line, which represents a 30 PE ratio. But since that time, since actually 2008, the Great Recession, you can see that the price has separated from its earnings line, and now we see the importance of the normal PE ratio. But since the Great Recession, the market has routinely applied a 21.7. To be clear, we're simply saying here that it makes some sense to be willing to pay a 21 or 22 multiple to buy this stock. Obviously, it's better if you can buy it when it's below that multiple. It currently trades at 22.4 times earnings, or right on the blue line. But here again, we see the expression of earnings and price and the correlation that helps us make a decision. MasterCard is not necessarily a great buy here, but it's certainly a reasonable buy at 21 times earnings based on its historical growth. We can see the company does pay a dividend, but it pays a very small portion of its total earnings out, and the dividend yield is only 0.5%. The company has no debt to capital, trades on the New York Stock Exchange, has a market cap of $60 billion already, but you can see a very fast-growing investment here thanks to what FastGraphs reveals.